All right, diving in today. We're going deep on a true classic, a book that's, well, let's just say it's earned its place in the Hall of Fame for investors. Benjamin Graham's The Intelligent Investor. And what makes this deep dive even more interesting is that we're starting right at the beginning with the preface and the introduction.
And we've got some pretty big shoes to fill, right? I mean, Warren Buffett himself called this by far the best book about investing ever written when he was just 19 years old. And guess what? He still says the same thing.
That's a pretty strong endorsement, especially coming from someone who's, kind of known for his investing skills. So for anyone listening who wants to get the most out of their time, this deep dive is all about pulling out the core of Graham's investment philosophy. We're going to break down those principles that have stood the test of time, the ones that are just as relevant today as they were when Graham first put pen to paper.
Exactly. And the beauty of it is, you don't need to be a Wall Street whiz to grasp these concepts. We're aiming for clarity here, making sure even if you're just starting out with investing, you can walk away with a solid understanding of Graham's approach.
So what's our mission today? Well, we want to figure out why this book, The Intelligent Investor, is still considered such a must-read. What are the key ideas that Graham lays out right from the get-go? And how can those ideas help you, the listener, make better decisions with your own investments? Plus, we'll touch on the historical context because you know what they say, history often repeats itself.
And speaking of history, we can't dive into The Intelligent Investor without acknowledging the impact it had on Warren Buffett himself. His preface to this book is pretty much a masterclass in what it takes to succeed as an investor. And the interesting thing is he starts by talking about what you don't need.
So what doesn't matter according to Buffett?
Well, he says you don't need to be some kind of genius with an off-the-charts IQ. You don't need some sort of crystal ball to predict the future or have access to insider secrets. None of that is the key.
So if it's not about being a financial mastermind or having insider info, what is it about?
Buffett boils it down to two things. One, you need a solid mental framework for understanding how investing actually works. And two, you need the emotional discipline to stick to that framework even when things get a little, shall we say, exciting in the market.
It's like having a game plan and not letting your emotions throw you off course.
Exactly. And according to Buffett, Graham's book is like the ultimate playbook for developing that winning mindset. He even singles out chapters 8 and 20 as absolute gold mines of wisdom.
Chapters 8 and 20. All right, we'll definitely have to come back to those in a future deep dive. But even in this preface, it's clear what Buffett wants us to take away. If you really understand and internalize Graham's principles, you should be able to avoid making major investment blunders. In fact, he goes so far as to say that simply not messing up is a pretty big accomplishment in the world of investing.
You know, that's a really important point. So many people get caught up in trying to hit home runs, but Buffett's saying sometimes just staying in the game is the win. And he ties this directly to something Graham talks a lot about, how the market often behaves in ways that are just plain irrational.
Irrational, huh? So we're talking about the emotional roller coaster of the market, all the ups and downs that can make even seasoned investors feel a bit queasy.
Precisely. Buffett calls it stock market folly. Those times when fear and greed take over and prices have absolutely nothing to do with a company's actual worth.
So Graham's principles are like a shield against that emotional chaos.
More than a shield, they're like a map, showing you how to navigate those turbulent times and maybe even use them to your advantage. Because when emotions are running high, that's often when the best opportunities present themselves, especially for investors who are sticking to Graham's value-focused approach.
Opportunities arising from the mistakes of others, that's classic contrarian thinking.
Exactly. Now, we've talked a lot about what Buffett says in this preface, but it's important to note it's not just about the content of the book. This preface reveals a very personal connection between Buffett and Graham.
He even calls him one of the most influential figures in his life, right up there with his own father.
Yeah, and he includes a short, touching piece that he wrote about Graham shortly after his passing.
That's right, a real glimpse into their relationship. So what did Buffett admire so much about Graham, aside from his brilliance in finance?
Well, he shares a wonderful little anecdote about Graham's daily goals. He said Graham aimed to do something foolish, something creative, and something generous every single day.
That's so cool. It paints a picture of a man who wasn't just about numbers and spreadsheets, but also about living life with a sense of humor, imagination, and a big heart.
And it really speaks to Graham's legacy. Buffett clearly sees him as more than just a finance guru. He was a teacher, a mentor, and genuinely cared about passing on his knowledge and wisdom to others.
And that brings us to one of Buffett's most powerful statements about Graham. calling him the founder of security analysis as a discipline. Now, for anyone who's not a finance geek, security analysis is all about digging deep into a company's financials, looking at its health and performance to figure out what it's truly worth, not just what the market says it's worth.
And here's the kicker. Even after all these years with all the changes in the financial world, Buffett still believes that Graham's work is the gold standard. Nothing's come close to surpassing it.
It's like the foundation of a house, the bedrock that everything else is built upon. And when you read Buffett's description of Graham's intellect, it's not hard to see why his work has had such a lasting impact.
Buffett talks about his virtually total recall, his unending fascination with new knowledge, and his ability to connect ideas from different fields in ways that most people wouldn't even consider.
He had this incredible mental library, and he could pull out exactly the right book no matter the topic.
Absolutely. And remember, those three things Graham tried to do every day: foolish, creative, and generous. Well, that generosity shines through in Buffett's tribute. He talks about Graham's open-ended, no-scores-kept generosity of ideas, time, and spirit as a teacher, employer, and friend.
So it wasn't just about the knowledge, but about sharing it freely and supporting others.
Exactly. And Buffett wraps up his preface with a beautiful image comparing Graham to someone who plants trees that other men will sit under. It perfectly captures the essence of Graham's legacy. His work continues to provide shade and wisdom for generations of investors.
All right, so we've got Buffett's take. Now let's move on to Jason Zweig's A Note About Benjamin Graham, which gives us even more context about the man himself.
Right. And Zweig starts by making his own bold statement, calling Graham the greatest practical investment thinker of all time.
So we're talking about someone who took the world of investing and turned it from a game of speculation into a true profession. Right.
Exactly. And Zweig credits Graham's earlier work, Security Analysis, with being the driving force behind that transformation. But he positions The Intelligent Investor as the perfect guide for individual investors, the ones who are managing their own money and trying to make smart decisions for the long haul.
It's like he's saying, look, if you want to navigate the market successfully, this is your roadmap.
And what's really compelling is Zweig's personal story about reading The Intelligent Investor in 1987. He was struck by Graham's conviction that bull markets always end, and usually not in a pretty way.
Talk about perfect timing, right? Because what happened just a few months later? The stock market crashed.
It's a powerful reminder that while market conditions change, human behavior and the underlying principles of investing tend to remain remarkably consistent.
So let's talk about Graham's background. Zweig digs into that a bit, right?
He does. He starts by describing Graham's early life. He was born Benjamin Grossbaum, interesting side note, and his family initially did quite well financially, but then tragedy struck. His father passed away, and his mother lost a significant portion of their wealth in the 1907 financial panic.
So he experienced financial insecurity firsthand quite early in life.
Exactly. And this experience, seeing how quickly fortunes could change, had a profound impact on his approach to investing. It instilled in him a deep sense of caution and a strong aversion to unnecessary risk.
It makes sense.
Yeah.
You don't forget those lessons, especially when they're learned the hard way.
But despite facing these challenges, Graham was an exceptional student. He won a scholarship to Columbia University and graduated near the top of his class. And get this, at just 20 years old, he was offered teaching positions in multiple departments.
Wait, multiple departments. We're talking about finance, right?
Not just finance, English, philosophy, even mathematics.
Yeah.
Wow, so we're talking about a serious intellect here, someone with a wide range of interests and abilities.
And that's key to understanding his approach to investing. He brought this broad intellectual perspective to everything he did. But instead of pursuing a traditional academic path, he made a conscious decision to jump headfirst into the world of Wall Street.
So he went from the ivory tower to the trading floor.
Exactly. He started as a clerk, learning the ropes from the ground up, and eventually built his own successful investment partnership.
That's a pretty unique combination. A brilliant mind, academic training, and real-world experience in the trenches of finance.
And that combination shines through in some of the early examples Zweig shares of Graham's investment insights. There's the case of Savold Tire in 1919, which highlights the dangers of getting caught up in market hype. This stock skyrocketed on its first day of trading, but quickly crashed to zero because the company itself was built on a foundation of, well, let's just say shaky fundamentals.
It's a classic case of too good to be true. A reminder that sometimes the market gets carried away with a story, even if the underlying business isn't there to support it.
Exactly. And then there's the example of Northern Pipeline Co. in 1925. This one really demonstrates Graham's meticulous research approach. He was digging through some obscure regulatory filings and stumbled upon a company whose stock was trading at a huge discount compared to the value of its assets, which were primarily high-quality bonds.
So it was like finding a $100 bill lying on the sidewalk just waiting for someone to pick it up.
Pretty much. And Graham didn't just find this hidden gem, he actively engaged with the company's management, pushing them to unlock that hidden value. And guess what? It worked. His investors made a substantial profit thanks to his diligence and proactive approach.
So it's not just about finding undervalued assets. It's about having the conviction to act on your research and sometimes even shake things up a bit to unlock that value. Now, we can't talk about Graham's history without mentioning the Great Crash. He took some serious losses, right?
He did. But what's important is that he not only survived that devastating market crash, but actually went on to thrive in the years that followed.
So his approach wasn't just theory, it actually worked in the real world, even during some of the toughest market conditions imaginable.
Exactly. His investment firm, Graham Newman Corp., achieved consistently impressive returns, beating the market for 2 decades straight. It's a testament to the enduring power of his investment philosophy.
And Zweig helpfully summarizes those core principles, which I think is a great way to anchor ourselves before we dive into Graham's own words.
Absolutely. Let's go through them one by one. First, the idea that a stock represents ownership in a real business.
So it's not just a ticker symbol on a screen, it's a piece of a company that's out there creating products, providing services, making things happen.
Exactly. And this principle encourages investors to think like business owners, to focus on the company's performance and long-term value creation, not just short-term stock price fluctuations.
It's like saying, if I own this entire company, would I be happy with how it's being run? Would I be confident in its future?
Right. Now, the second principle is the idea of the market as a pendulum, swinging back and forth between unsustainable optimism and unjustified pessimism.
So it's like the market has its own mood swings, driven by fear and greed.
Precisely. And Graham's point is that the intelligent investor uses these emotional swings to their advantage. They buy when everyone else is panicking, and they sell when everyone else is overly optimistic.
Buy low, sell high, that's the goal.
Yeah.
But easier said than done when you're caught up in the frenzy of the market.
Absolutely. And that's where the third principle comes in. The future investment value of an asset is determined by its present price.
So if you overpay for something today, you're limiting your potential returns tomorrow.
Exactly. Value investing is all about finding that sweet spot, buying assets that are priced well below their intrinsic worth, so there's room for growth.
It's like finding a bargain at a flea market, knowing you got something valuable for a steal.
Right. And that brings us to the fourth principle, the concept of a margin of safety.
Which is basically acknowledging that even the best investors can be wrong sometimes.
Exactly. No one can predict the future with perfect accuracy. So you build in this buffer, this margin of safety, by buying assets at a significant discount to what you think they're worth.
It's like that extra cushion in your budget, just in case something unexpected happens.
Right. It protects you from those unforeseen events and those occasional mistakes in judgment. And finally, the fifth principle highlights the importance of controlling your own behavior as an investor.
So it's not just about picking the right stocks, but about managing your emotions and not letting fear or greed dictate your decisions.
Precisely. Graham believed that an investor's biggest enemy is often themselves.
It's like that inner voice that screams, sell, when the market dips,
Yeah.
even though you know logically that it might be a buying opportunity.
Exactly. And Zweig really drives this point home, saying that long-term success is more about controlling your reactions to market fluctuations than about trying to perfectly time the market.
It's about staying calm and rational when everyone else is losing their heads.
Right. Now, before we move on to Graham's introduction, Zweig also points out something really helpful about the structure of this revised edition of The Intelligent Investor.
So it's not just a straight reprint of the original, right?
It's not. It combines Graham's original text with Zweig's own commentary, which helps to apply these timeless principles to today's markets.
So you get the best of both worlds, the original wisdom and modern-day insights. It's like having a guide who can translate the ancient scrolls for a contemporary audience.
Exactly. And Zweig concludes his note with a sense of excitement for the reader, saying he believes Graham's work will be both enlightening and empowering. So let's see what Graham himself has to say in his introduction.
Let's do it. He starts off by stating the book's purpose pretty clearly, right?
He does. He wants to provide practical guidance for the average person, the non-professional investor, to help them create a sound investment policy.
So this isn't a book for Wall Street hotshots. It's for everyday people who want to manage their money wisely.
Exactly. And he emphasizes that the book focuses on the big picture, the fundamental principles and the mindset of a successful investor, rather than getting bogged down in complex technical analysis.
Which makes sense if you're trying to reach a broader audience, people who might not be finance experts.
Right. But he does mention that he'll be using real-world examples, comparing specific stocks to illustrate key concepts.
So it's not just theory. It's grounded in practical application.
Exactly. Now, one of the first things Graham emphasizes is the importance of understanding historical market patterns. He even quotes a very famous line by the philosopher George Santayana: "Those who do not remember the past are condemned to repeat it."
That's a powerful statement, and it's so true when it comes to investing. If you don't understand the mistakes of the past, you're more likely to make them again in the future.
Exactly. Graham believed that studying financial history was absolutely crucial for making informed decisions in the present.
It's like learning from the experiences of those who came before us.
Right. And he makes a very important distinction right off the bat. This book, he says, is for investors, not speculators.
So there's a difference between those two. It's not just semantics.
It's a fundamental difference. An investor buys assets based on their underlying value, with the goal of holding them for the long term. A speculator, on the other hand, is more interested in short-term price movements, trying to time the market and make quick profits.
So it's like the difference between planting a tree and hoping it will grow into a strong oak versus just flipping houses trying to make a quick buck.
Perfect analogy. And Graham makes it clear this is not a get-rich-quick scheme. There are no shortcuts or guarantees in the world of investing.
And he uses a really interesting example to illustrate this point. He talks about a guy named John J. Raskob, who back in 1929 wrote an article called "Everybody Ought to Be Rich."
Right, in the Ladies' Home Journal, no less.
Yeah.
And Raskob basically argued that anyone could become wealthy by investing a small amount of money in the stock market every month. He predicted these incredibly optimistic returns over a 20-year period.
So what happened? Did everyone become rich?
Well, unfortunately, Raskob's predictions were way off. The market crashed just a few months later, and the actual returns over the next 2 decades fell far short of his rosy projections.
So it's a cautionary tale about the dangers of blind optimism and believing that the market only goes up.
Exactly. But there's an interesting twist to this story. Despite starting at the peak of the market, just before the crash, a strategy of consistently investing a fixed amount every month, what we now call dollar cost averaging, would have still yielded a decent return over the long term.
So even in a challenging market environment, discipline and consistency can still pay off.
Exactly. And that brings us back to Graham's core message: focusing on sound principles and long-term value creation rather than trying to chase quick profits or time the market. He criticizes what he calls technical approaches to the market, which rely on charts and patterns to predict future price movements.
So he's skeptical of those who claim they can predict the market based on technical analysis.
Extremely skeptical. He basically says it's the opposite of sound business sense, and that in his 5 decades of experience, he's never met anyone who's consistently made money that way.
No magic formulas, no crystal balls. It's about understanding the fundamentals of investing and being patient.
Right. Now, Graham also acknowledges that the financial landscape has changed significantly since the first edition of The Intelligent Investor was published.
He's talking about the differences between 1965 and 1971.
Right, exactly. He lists several major developments that have impacted the investment world, including rising interest rates, a stock market decline, persistent inflation, the rise of conglomerate companies, and increased financial complexity overall.
So the world's a different place, but are the principles of investing still the same?
That's the key question, and Graham's answer is nuanced. He says the underlying principles of sound investment remain constant, but their application must adapt to changes in the financial environment.
So it's like having a set of tools but knowing how to use them in different situations.
Exactly. He also mentions that he wrote this revised edition during a period of market volatility, with the first draft finished during a recovery and the final draft during a decline.
So the market was going up and down, but his core investment philosophy remained unchanged.
Right. He saw those fluctuations as normal market behavior, not something to panic about or drastically alter your strategy over.
It's like saying, don't get caught up in the short-term noise. Focus on the long-term game.
Exactly. And he specifically talks about how the market decline of 1969-1970 shattered the illusion that certain popular stocks were somehow immune to losses.
So those can't-miss stocks, the ones everyone thought would only go up, they came crashing down to earth.
They did. And Graham warns about the dangers of getting caught up in that kind of market frenzy where prices become detached from reality. He also points out that even some professional investment funds had heavily invested in these risky stocks, leading to substantial losses.
So even the experts can get caught up in the hype.
Absolutely. And then he highlights a really interesting challenge that was present at the time. Bond interest rates were significantly higher than the dividend yields on stocks.
So you could potentially make more money simply by holding bonds, which are generally considered less risky than stocks.
That's the question Graham raises. It challenges the traditional assumption that stocks should always outperform bonds over the long term.
So he's not afraid to adapt to changing market conditions and ask tough questions.
Exactly. And he revisits the distinction between defensive investors who are more passive and risk-averse and enterprising investors who are more active and willing to take on more risk.
So different approaches for different types of investors depending on their goals and risk tolerance.
Right. Now, here's where things get really interesting. Graham challenges the popular investment strategy of just focusing on high-growth industries and companies.
So not just chasing the next big thing, the latest hot stock.
He uses the example of air transport stocks in the late 1940s and early 1950s.
The airline industry, that was booming back then, right?
It was. Passenger traffic was growing rapidly, but the problem was many of these airline companies weren't actually profitable.
So all that growth didn't translate into profits for investors.
Not necessarily, and this example highlights one of Graham's key points. Obvious growth in a business doesn't automatically guarantee profits for the investors.
It's like saying, just because a company is getting bigger doesn't mean it's getting better at making money.
Exactly. And he contrasts this with the example of IBM, which was a highly successful company. But he points out that many investment funds had relatively small positions in IBM despite its success.
Why is that? If it was doing so well, wouldn't they want to invest more?
Well, because its stock price was considered high and its future growth rate was uncertain. So even though it ultimately performed well, many investors were hesitant to go all in.
So it's not just about finding a company that's doing well, it's about buying it at the right price.
Exactly. And he uses these contrasting examples to draw two important morals. First, that growth in a business doesn't always equal profits for investors. And second, that even the experts often get it wrong when trying to pick the winners in a fast-growing industry.
So be cautious about blindly chasing the next big thing.
Right. And now we get to the heart of Graham's mission with this book, to help investors avoid major mistakes and develop a comfortable, sustainable approach to investing.
And he has that famous quote about investors being their own worst enemy, right?
Exactly. He believed that our own emotions, our fear and greed, can often lead us to make irrational decisions.
So it's not just about knowing the numbers, it's about mastering your own psychology.
Right. And he argues that ordinary people who have the right temperament, who are patient and disciplined, often do better than those with lots of knowledge, but who lack that emotional control.
So it's like saying you don't need to be a genius to be a good investor, you just need to have the right mindset.
Exactly. And he emphasizes the importance of always relating the price you pay for an investment to its underlying value.
So don't just blindly buy something because it's popular or the price is going up.
Right. He uses a simple analogy: buying groceries versus buying perfume. With groceries, you're focused on the value, on getting the most for your money. With perfume, you might be more influenced by emotions or status.
So with investing, it's about being more like a grocery shopper and less like a perfume buyer.
Exactly. And he points out that many big investment losses happen when people forget to ask the simple question, how much is this worth?
So always do your due diligence, your research, and make sure the price you're paying is justified.
Right. Now, Graham gets into some specific recommendations for common stock investing, both for defensive and enterprising investors. And what's interesting is that he suggests limiting investments to companies that are selling at a price not far above their tangible asset value.
So focusing on companies that are essentially undervalued by the market.
Exactly. And he acknowledges that this might seem old-fashioned, but he gives some compelling reasons for it. First, it reduces your dependence on the market's fluctuations.
So if the market takes a dip, you're less likely to panic because you know you bought those stocks at a bargain price.
Right. And second, it gives you a sense of security, knowing that you own a piece of a solid business at a rational price.
It's like having a safety net. Now, Graham also touches on a really important point. Achieving a decent investment return doesn't require a huge amount of effort or expertise. But he says if you want to significantly outperform the market, that's when things get tricky.
It's like saying anyone can learn to swim, but becoming an Olympic swimmer takes a whole other level of dedication and skill.
And that ties into his point about the difficulty of beating the market consistently, even for professional investors. He basically says that trying to be too clever or too active can often backfire.
Exactly. And he even expresses skepticism about those brokerage house predictions that claim to know where the market is headed.
So take those predictions with a grain of salt, right?
Definitely. And he reiterates the value of a simple, diversified portfolio with a mix of high-grade bonds and leading common stocks.
So a solid foundation, not trying to get too fancy or chase the latest fads.
Right. And he emphasizes the need for self-awareness, knowing your own strengths and weaknesses as an investor, and seeking advice from trustworthy sources.
So not just following the herd or blindly trusting anyone who claims to have all the answers.
Exactly. And finally, Graham concludes his introduction with a reminder that a sound investment approach, focused on value and a margin of safety, has the potential to deliver great rewards.
But he stresses that it takes discipline and a long-term perspective.
Right. And he ends with a reflection on the unpredictability of the future. He recalls how World War I broke out shortly after he entered Wall Street, a reminder that no one can truly know what the future holds.
But despite all the uncertainty and change, he expresses confidence in the enduring power of sound investment principles.
Exactly. And he clarifies that his book focuses specifically on marketable securities, like stocks and bonds, not other types of investments like real estate or insurance.
So a focused approach to a specific area of investing. And he also clarifies that whenever he uses the word now in the book, he's referring to late 1971 or early 1972 when this revised edition was being written.
Helpful timestamp for the reader. So to wrap up our deep dive into this preface and introduction, we've seen Graham's emphasis on a clear framework for investing, the importance of emotional discipline, and the difference between investing and speculating.
And we've seen how both Warren Buffett and Jason Zweig view these principles as timeless, just as relevant today as they were decades ago.
Exactly. The idea of focusing on value, not price, and demanding a margin of safety in every investment, these are the cornerstones of Graham's approach.
And it all comes down to thinking rationally, not emotionally, and making decisions based on sound principles, not market hype. Now, to leave you with a final thought, something to ponder as you continue your own investment journey. If Graham were here today, looking at the current market landscape, what do you think he would say about some of the popular investment trends and high-growth industries that are all the rage?
Would he see those as genuine opportunities or potential traps?
What hidden risks might be lurking beneath the surface of those seemingly can't-miss investments? It's a question worth asking, and that's the power of the intelligent investor. It gives you the tools to ask those tough questions and make informed decisions.
And hopefully it helps you avoid some of those costly mistakes that can derail your financial future.
Exactly. So if you haven't already, we highly recommend picking up a copy of The Intelligent Investor and diving into its wisdom. You might be surprised at how relevant and insightful it remains, even in today's fast-paced, ever-changing world.
And remember, as Graham himself said, the investor's chief problem is often themselves.
So be your own best advocate, stay informed, and keep learning. Thanks for joining us on The Deep Dive.